Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at Fidelity's target allocation, 100% aggressive ETF model portfolio. Now, this is a portfolio that provides exposure to developed equities, so that means US and international stocks, and it does it via 12 ETFs plus a bit of cash. If we look at the kind of like ETFs in these portfolios, most of them are from Fidelity. And we can see the three largest allocations are the Fidelity International Multi-Factor ETF, Fidelity Momentum Factor ETF, and Fidelity US Multi-Factor ETF. Before we actually jump into the analysis of this model portfolio, it's worth highlighting that if you see an equities focus portfolio with 12 funds and cash, that's already kind of a red flag in the sense that there's going to be overlap between those funds. It's unnecessarily complicated. But let's investigate and see if I'm right or wrong. Now, from a benchmark perspective, the kind of auto-suggested benchmark is the MSCI World Index. And if you look at the performance of this portfolio, right, we can go back to 2021. But it's actually quite difficult to see any difference to the MSCI World Index, right? Because the lines are basically on top of each other. Now, we can continue to try to learn more about this portfolio by looking, for example, at the breakdown by countries and by market capitalization. As mentioned, this is only stocks in this portfolio. And so if we move down here, we can see what primarily large cap stocks, right? 91%, got a little bit of mid cap in there. And from a breakdown by country, it's about 66% US, 29% international. And then if we look at international, this is basically Japan, UK, Europe, which mirrors the breakdown by countries of the MSCI World Index. We can also look at a factor exposure analysis in the sense of, is there any consistent exposure to factors like value, momentum? Now, given that this portfolio has a variety of multi-factor ETFs, and here we got value, dividend, but we also, I think, have a growth fund in here. In general, there is no consistent biases to factors, except perhaps to the quality factor. And we can see there is a negative exposure to the quality factor, and we can attribute that to a meaningful amount of value and dividend funds in there, because kind of companies that are cheap or that are paying high dividends tend to be poor on quality metrics like leverage and profitability. But overall, there's not a lot of consistent equity exposure. And we can also see that via the risk sources analysis, that the primary risk of this portfolio is just the US stock market. The equity factors, which you can see over here, is actually you cannot see that very clearly, right? Which just highlights that factors didn't contribute much to the performance performance and risk of this portfolio. Now, moving on, we can have a quick look if we can reduce the fees of this portfolio. And so we're simply going to look at if we can replace the funds in this portfolio with passive benchmarks. And so, for example, we can see, for example, this American Century Focused Dynamic Growth ETF, FTG. It charges 45 basis points. And our suggestion is that we replace that with the Fidelity Nasdaq Composite Index ETF, which is available via ONEQ for 21 basis points. Now, you might question how good or bad our replacement with ETFs is that track passive benchmarks, and we can prove that down here. So over here, we do see that the Fidelity model portfolio actually, well, it did slightly outperform, right, this kind of optimized portfolio. Having said that, the optimized portfolio would be cheaper at 8 basis points versus 21, and the outperformance are consistent. Finally, let's have a quick look if we can simplify this portfolio. As mentioned, this is quite large with, well, 13 securities, which are 12 ETFs and a little bit of cash. And what we see over here is that well, the combination between the MSCI World and the Vanguard Total World Index, right? That would have replicated this portfolio quite closely. And that's 2 securities versus 13 securities, and fees would be 21 versus 15 basis points. Now we do see, of course, that again, this model portfolio has slightly outperformed the simplified portfolio, as well as the cheaper portfolio that we looked at a minute ago. But it is worth recalling that we're looking at the performance of this portfolio as of today. And what tends to happen with model portfolios is that the model portfolio provider, which is Fidelity in this case, that they tend to do what unfortunately almost every investor does, is performance chasing. So they tend to include ETFs that have performed well recently, and that kind of, well, it makes the returns look back or look attractive going back. But of course, it doesn't mean that this portfolio will outperform going forward. Now, that kind of concludes our analysis of Fidelity's target allocation 100% aggressive ETF portfolio. As discussed, this provides exposure to developed equities, but as you've seen from a performance perspective, this portfolio is indistinguishable from the MSCI World. And so instead of paying 21 basis points to Fidelity, you can simply buy the MSCI World Index for 15 basis points. Hope that helps. Have a nice day.